Well, hello to all my big trenders. This is Price Headley. It is Wednesday morning, November the 11th, 2009. Wanted to update you on the markets and also just give you a little quick lesson about how you can get on board fast moving stocks when you think maybe they've run too far and where's the spot to get back on board. Uh, Trade I recently made in Amazon.com in my Option Shark options recommendation service. Basically, you see Amazon had the huge breakout on the earnings coming here back on October 23rd. Stock shot up over 20 points. It had been at $94. Then up to 118 and a half at the close. So, just a huge 23-point pop. And then another big day to follow through, which was actually in my work bullish that it got the percent R follow through above that overbought level, closed over that high, 119.65, the very next bar, 124.64. Now what? How do you get on board when this thing's taking off? You can see that our Bollinger Bands, these are 20-period Bollingers with two deviations in green here. We got the breakout outside of there. More importantly, the Bollingers are surging outside the acceleration bands, but then the stock goes through a normal little catch its breath phase. So you can see that actually as Amazon settles back down here right near the acceleration band in red, that's providing major support. In turn, we got a percent R retest coming in right around the 116 and 3/4 area. So we actually put out a buy recommendation on the December 125 calls for Option Shark subscribers. Bought the options at $4.30. I had 420 was the average. Actually, it said up to 430, but we said okay, we're buying it at an average of 420. Well, I had some subscribers say, "Whoa, that's in this case about 8 points plus out of the money. Why would you buy those options?" And I said, "Well, based on the way the options are priced, if we get about a 10-point move in the stock, we should double those options, and that will allow us to sell half of the position." Why was I also confident? Because we're coming in right into this retest level, so I know that if I'm wrong, if this not only if this low breaks 116.76, but also on a closing basis, also if the acceleration bands breaks, those two things together would tell me, okay, we're wrong. We need to get on out. Stock's not holding like it should. You can see we get a classic little bend but don't break where it tries to test under their intraday on November 5th last week, and then it snaps right back up, closes over 120. So a beautiful flip back to the upside. Then the stock got upgraded the next morning. Again, there's always some rationale for the markets, but my view is that the chart structure doesn't lie. Stock just ran up to 130 here yesterday, and we've locked in half of our position at a double. Now we're riding the rest still as a free trade. Whatever happens from here happens. We're going to continue to follow the percent R, watch the retest points, and then in the meantime see if we can scale out still further. My ultimate target's up near 140. I'll go on the record and saying let's see if we can get to 140 here before the December expiration. That's just a quick little overview for you. Now our quick market update. As we look at the big averages, the NASDAQ 100, I've been talking about how we've been in a trading range, and it really shows up here when you see the Bollinger Bands in green staying inside of the acceleration bands. We've seen that here for the last couple of months, really going back here into early October, and you can see that basically the low end of the range we hold that that midpoint on the 50 level for the Nasdaq. That's on the percent R. That's a good sign for that short-term window. We actually broke it, and now we've just rallied back above it here. So we're really in a lot of chop as we sit here. But the bottom line is that we're getting near the upper end of that range after just coming off the low end of that range when the VIX spiked. We'll look at the VIX in a minute. Fear levels really jumped here at the start of November. That was a good sign for the market. We've now reversed that, coming right back up, and you can see where's the resistance on these bands. You can see it's sitting right about 44.2 up to about 44.5. So basically we're looking at resistance here. That's a marginally higher level than where we were at that 43 3/4 peak on the last test of the bands, but the bands have expanded a little bit. The range has broadened a little bit. So, but the bottom line is it's getting time to lock down some bull profits here. So keep that in mind here as we look at these other averages. They're all going to pretty much support that. We're right at the upper Bollinger Band for the Dow, the DIA, sitting here about 102.60 is the upper band. We've tested at the top yesterday, and with this morning's gap up, suggests that 104 is kind of your best case scenario. We're sitting around 103. But bottom line is that we're just now rallying back above that midpoint 50 level. All these things to me suggest a cooling off is now a good expectation here over the next week, week and a half into next Friday's November options expiration. You can see the S&P got the same kind of a pattern. We hit right at that lower band, right down around the 103. 103 and a quarter area, and then basically snapped off there. Look at where we're at. We're right back to 110 on the S&P 500. That's the equivalent of 1100 on the SPX, the S&P 500 index. That's of course, spiders trade about 1/10 of that. But bottom line is 110 is a big number, or 1100 for the S&P 500 index SPX. This is telling us, along with the jump right up to the top of the range, and then sort of the stall there yesterday, that even with today's attempted rally, don't be surprised to see some profit taking here as we're right into the resistance, and the upper bands are just above about 111.5. So a little bit more risk and reward from a trading range perspective. And of course, the VIX is one of the key tools that I use to really gauge the fear or lack of fear in the market. You remember I was telling you to be cautious back in this zone back in mid-October, where we had really lost all sense of fear. The VIX dipped all the way down to tag these lower bands, the red acceleration bands, 3 out of 4 days. And you can see that we were getting ready for that big snap up where fear returned to the market. Remember, the fear cycles, it goes through fear and greed really cycle. I call greed really a lack of fear. So when you're seeing a lack of fear like you saw back here, people are getting too greedy, too optimistic. That's setting expectations too high into earnings season there. And of course, a lot of companies had big numbers and still dropped after the quote-unquote great news. So it told you that that was already priced in the stocks at those levels. We had to get this big shakeout into the start of November here. That was the last day of October, actually the 30th, that Friday of October. We spiked all the way up to about 31.5 on the VIX. The key was that was an overbought zone on %R, but the key was it did not follow through above that high. If it had, we could have been in for a lot more pain above 31.59. We didn't go and close above there. We tried to trade above there that next Monday, the 2nd, and flipped right back down. So I told you that the market was due for this recovery that we've had as fear has now ebbed. And now we're right back to a key number near 23. Also, %R dipping down right near the oversold level. So we've come about as far as we're likely to come on this move to the upside. Again, tells us we should be taking a break. And it tells you what should you be doing with your positions. Again, my 2 cents. Again, this is education, not specific recommendations. We've saved that for our Option Shark subscribers and other paid subscribers. But the bottom line is that generally you want to be tightening your stops on your bull positions, peeling off some profits, and looking to kind of get back towards a cash position. I'm not saying to go call a top, but I'm saying just to lighten up and thus be, I think, a little wiser and more prudent as we look for fear to eventually come back in. I'd expect to see a run back up at some point towards this 29 area. Long term, I don't want to see the VIX getting over 30 and staying above these bands. That would be a bad sign. But right now, the range is basically 20 to 30. You can see the lower band's a little bit below 20. But 20 is a big number on the downside, and then 29 to 30 is going to be a big number on the upside here. So basically, 20 to 30 range, pretty wide percentage range really, and we're right back to 23 as a secondary support off of these prior few tests back in October and back into even July. We saw a test down near 23. So we're right near a stall point for the market. Don't be surprised to see some profit taking, and play it close to the vest as always. Hope you enjoyed this and keep on trading well. We'll see you again next week.